Good evening, everyone, and welcome to today's market wrap. It was a brutal session across global markets, with a wave of panic that started in Asia spilling over into Europe and the US. Let's get straight to the numbers. The Nasdaq 100 closed down 1.5%. The S&P 500 fell 1.14%. The Dow Jones also slipped, down about 0.7%. The VIX, our fear gauge, surged nearly 7% to close at 18.43. The 10-year Treasury yield broke through 4.6%, up 3% on the day. The dollar index firmed at 99.27. Offshore yuan traded at 6.8139 in New York. Bitcoin dropped nearly 3% to $79,100. WTI crude settled at $101.16, but market sentiment was actually lifted by Brent crude. Spot gold fell 1.65% to $4,543.60. The strongest sector today was energy, and in the A-share market, fluorochemicals and humanoid robots also showed relative strength. But the weakest sectors, global semiconductors and high-growth tech stocks, were absolutely hammered. Let me give you a clear characterization of today's market. This was a washout. Money flowed out of high-valuation tech stocks and risky assets like cryptocurrencies in a big way. It moved into dollar cash and short-term treasuries for safety and yield. Some money also rotated into crude oil as a geopolitical hedge. The overall picture is one of clear risk-off and a wait-and-see attitude. When we trace the path of this sell-off, the turning point was clearly in Asia. South Korea's Kospi index collapsed more than 6% on a Samsung strike crisis and panic in the chip sector, triggering a circuit breaker. It was the undisputed leader of the decline. Japan's Nikkei and Hong Kong stocks followed suit. The A-share market showed some relative resilience, but ultimately couldn't hold off the selling pressure. When Europe opened, it fully absorbed the Asian panic. Germany's DAX and the Euro Stoxx 50 both fell more than 2%, with no attempt at a recovery at all. The US market opened under pressure and traded in the red all day. The core driver was the 10-year Treasury yield spiking and holding above 4.6%, which directly crushed the valuation models for tech stocks. Chip leaders like Nvidia and growth names like Tesla were the main targets of the sell-off, and the major indices closed near their lows of the day. One of the most telling signals today was that the market completely ignored a potential positive. The US approved Nvidia to sell H200 chips to Chinese companies. This should have been a positive for chip stocks, but instead they led the decline. This is a classic case of ignoring good news equals weakness. It tells us the market's main concern right now is not industry-specific stories. It is macro liquidity tightening and interest rate pressure. We had been leaning into the view that the AI theme could maintain structural strength. Today's tech rout proved that judgment completely wrong. Our core error was a misjudgment on interest rates. We severely underestimated the destructive power of the 10-year yield breaking above 4.5% on tech stock valuations. When interest rates become the elephant in the room, all growth stories look pale and unconvincing. We are seeing a clear negative correlation resonance between currencies, bonds, and stocks. In the bond market, the 10-year yield surging to 4.6% is the starting point driving all asset prices. The dollar index strengthened in response. Higher rates are attracting global capital back into dollar assets. The offshore yuan weakened, reflecting capital outflow pressure from emerging markets. In the stock market, the Nasdaq, as the most interest rate-sensitive asset, suffered the heaviest selling. This three-way resonance means a strong negative impact for Asian markets tomorrow. As long as the Treasury yield and the dollar index haven't peaked and started to fall, we need to be very cautious about any bounce in Asian stocks. The main capital flow theme, short tech stocks and long dollars and interest rates, is evolving from a trading idea into a market trend. It has been building for 2 or 3 days and was strongly reinforced today. The semiconductor sector is underperforming the market. Energy is outperforming, driven by Middle East tensions offering both inflation protection and a geopolitical hedge. Precious metals are underperforming because a stronger dollar and surging real yields make gold, a non-yielding asset, much less attractive. Looking ahead to tomorrow, we expect the A share market, the Nikkei, and the Kospi to open lower, digesting tonight's further decline in U.S. stocks. Market sentiment will be very negative, especially for tech-related sectors. However, the A share market may offer some relative safety. Valuations are lower, and China's monetary policy environment is not synchronized with the U.S. This could provide a margin of safety, with the Shanghai Composite potentially falling less than the Nasdaq. Oversold tech stocks like Nvidia may attempt a technical bounce, but the odds are low, and any rally is more likely to be a dead cat bounce than a real reversal. The real opportunity may lie in a share sectors with low correlation to macro interest rates and which have domestic policy support, like the humanoid robot theme we saw today. The biggest wildcard over the weekend is geopolitical developments, especially in the Middle East. Any escalation could further push up oil prices and worsen inflation fears. Let me give you a clear and powerful conclusion. Until the 10-year Treasury yield and the dollar index clearly peak and begin to decline, the market's dominant theme is risk aversion. Do not try to catch a falling knife. Wait for clear right-side signals before taking any aggressive long positions. Stay safe out there.